Hey everybody, today we're going to be doing another ETF review, and this time we're going to be looking at DHS, which is the WisdomTree U.S. High Dividend Fund. I wanted to do this in particular because this is a very good example of why you should research your funds and your stocks very heavily before going into them. You want to understand exactly what they're doing. So what is this ETF? It is looking to track the investment results of high dividend yielding companies in the U.S. equity market. So companies that have a higher than average dividend is what this is going to be invested in. The market cap doesn't really matter. This isn't a large cap or mid cap or small cap only, but it's mostly going to be large caps. That's where most of the money is going. So just be aware of that. What are its real goals? Targeted exposure to high dividend yielding companies. They say you can use it to complement or replace a large cap value and dividend-oriented active and passive strategy. And this one is very interesting. Used to satisfy demand for growth potential and income focus. I want you to keep that in mind as we go along. So let's look at the expense ratio real quick. We can see here we're sitting at 0.38%. Very average, not too high, not too low. It's not one of your super cheap under 0.1%, but it's also not getting anywhere near 1%, so very average. And then let's take a look at our yield. Currently we are sitting at 3.84%, which is higher than the S&P average, so it's not bad by any means. And the most recent dividend was 17 cents. Note that this is a monthly dividend, not a quarterly one, so you will be receiving a dividend every month. Now let's look at that distribution history and see how it looks. And here we go. As this is a monthly dividend payer, your dividends are going to vary from month to month because most companies pay their dividends quarterly, so you're going to have some months where you have companies that are paying a larger dividend paying, and the next month it might be companies that have a smaller dividend. So as we can see here, we have huge discrepancies. We have 4.5 cents up to almost 40 cents, down to 17.5 cents. Back in December, you got 63 cents, but the month before that, you were only getting 18.5 cents. So keep that in mind. If you're looking for something that's going to give you, I'm going to get 50 cents a month per share, or I'm going to get 40 cents a month per share, this isn't going to do it for you. It's going to vary. If you are using your investments as part of a budget, this might not be for you because it's really going to mess with that because you're not going to know exactly how much you're going to be getting each month. So just keep that in mind. Next, let's look at the holdings and see what the portfolio is invested in. I can tell you that they currently hold 318 stocks, which is a good number for any fund. When you think about the S&P holding 500, this has 60% of that, so you would think this is very well diversified. But when we take a closer look, if we look at the top 10 companies here, they account for nearly 45% of the total portfolio. I want you to think about that for a second. We have 318 holdings, and 10 of them are closing in on half. If we're thinking about diversity, this is very much not a diverse portfolio. Also, as we can see, the kinds of companies, our top two holdings, which are almost 11%, are tobacco. We also have AT&T and Verizon Communications also being almost 10%. So right here, 4 companies, you've got 20% of your portfolio. If those industries take a hit, 20% of your portfolio is going to take a hit. Keep that in mind. Also, remember when I talked about value and growth? If we look at these companies, not a lot of growth potential. They are big, they are well established, they're probably not going to go out of business, but I don't really see, AT&T, Verizon, Coca-Cola, Cisco, Broadcom really being growth companies. To claim that this is going to be for a growth strategy possibly for you is a bit disingenuous. Is it possibly that 1 or 2 or maybe even 3 of these top 10 holdings do really well and grow? Sure, but this is not a growth portfolio, so just remember that. Now, if we actually go into our holdings, we can see that we go from 5, 4, and 3% in our top holdings. We quickly drop down to under 1% once we get to 25. And then once we get down to the bottom, they're barely holding any shares. This, as an investor, this concerns me and confuses me. Instead of having 318 companies where, 200 of them are barely invested at all, why not narrow your focus down to 100 companies or 150 companies and evenly distribute, or mostly evenly distribute, your investment among them? these are really just useless holdings. You have 0.01%. Is this what, a single share that they're holding for some reason? Again, very concerning as an investor. This tells me that the people who are managing this fund really don't know what they're doing. They're just buying random things to supplement the larger holdings to say, oh, we have 300 plus holdings. This is very diverse. This is a good idea for you. Don't fall for that kind of thing. There are a lot of funds like this that'll do that. They'll say they have an exorbitant number of holdings, but if you actually look at the weighting, the top 10, 20, 30% of their holdings hold 90+% of the actual investment amount. So be very careful when you look at something like this. Next, let's look at our returns. And if we go up, we can see that our returns have been 1 month, 3 month, and year to date have all been very close. And our annual returns for 1 year did very well last year. 2020, everything did well. But here's where it gets a little interesting. 10-year, we're about matching the S&P. That's pretty good. But when we go back to the fund's inception, we're only doing about 7% a year. If you're just looking for income, 7% might be for you. But outside of that, 7% is very low. You can do better than that in other income strategies. Even just picking 4 or 5 stocks, you can do better than that. Even with a few other dividend funds, you can do much better than that. So this is quite low. For something that is completely in equities, there are no bonds or other kind of securities in this. Under 7%, very low. I don't like to see that, but that's just me. Next, let's go ahead and compare it. We'll have 3 portfolios here, one with Vanguard's S&P fund, one with the SCHD Schwab U.S. Dividend Equity Fund, and one with DHS. And if we go down and look, we can see that DHS has very, very heavily lagged its competitors. It's lagged the market by over 5% yearly returns, and even a similar fund, SCHD, it's lagged by almost 5%. As we can see here, they were doing about the same back to 2016, 2017. Then we saw a huge divergence. We also saw a much steeper drop and slower recovery when we had the crash in 2020. So this is quite a laggard compared to the market and other funds. As we can see here at our ending points, if we started with $10,000, you would have had about $13,000 less than if you just invested in the market, and about $12,000 less if you've been in SCHD. That's not great. If we look at our annual returns here, we can see that it usually lags the others. We have 2 years here where it outperformed the others, though not by much, but usually it's getting crushed. As we can see, even in 2020, it finished the year down, while the other 2 portfolios finished the year up. Again, kind of concerning, especially if you're an income investor. You don't want to see your capital disappearing over time. Just a bit concerning if you're asking me. So what do we take away from this? Who is DHS for? Is it for you? Is it for anyone? This is one of those funds where I'm going to say you should really just avoid it. I can't really think of a person who this would be good for, outside of maybe someone who likes a lot of the companies in its top 10 or 20 holdings and just doesn't want to invest in them individually. But at that point, you're just being kind of lazy, because you can find other funds that have a lot of those companies but do a lot better. This is a fund that lags the market, it lags its competitors, and it even claims to be growth, could be growth, when it clearly isn't. If I'm an investor, I'm staying away from this. There are much better high dividend strategies, much better pure dividend strategies in general, much better income strategies. Again, this is why you really need to do your research on your funds. This has 318 holdings, but almost all of its money is in about 20 to 30 different holdings, while the rest are just there to be a number. It's also not doing as well as its competitors, when really the dividend investing market has exploded over the last few years. You really want to see these funds doing about what the market is. If you can get a dividend fund doing 10%, which you can, you're doing okay. You're doing about the market. But when you have something that's averaging about 7% a year and is in pure equities, it's just not enough. It's not going to do it for you. Stay away from it. Another thing that I wanted to show you is the volume on this. This is a very low average volume of 56,000 shares traded per day. What does this mean for you? Maybe you do go into this fund. Maybe it has a good run up or something and you go into it. But then, it starts to lag the market or has a bit of a downturn. It could be very hard to get out of this position. You might have to sell, say if the stock's here, or excuse me, the ticker is sitting at $78, but it's only getting, 20 to 30,000 trades of shares per day. You might have to sell that well below $78 just to get out of the ticker. Just be aware of that. Volume is your friend when you're trying to move your money around. So again, just be careful, know what you're investing in, do the research, and you won't have to end up in something like this where you might end up heavily lagging the market or being stuck in an investment after you want to be. I hope this helps, and thanks for watching.